Get your free copy of the complete tutorial at www.teachucomp.com/free. Some companies receive advances and payments before actual services are performed. In accounting, this is called unearned revenue. Unearned revenue must be reported in order for companies to comply with GAAP principles. When the company receives an advance, it will debit a cash account and credit a current liability account, named something like unearned revenue. Later, when the company earns the revenue, it will debit the unearned revenue liability account and credit the appropriate revenue account. Let's take a look at an example. Company XYZ Inc. receives an advance of $1,000 from ticket sales in cash. The asset cash has increased $1,000, while the liability unearned ticket revenue has also increased $1,000. Since an asset and a liability have both increased, our equation will balance. Debits increase assets, so we would debit cash $1,000. Credits increase liabilities, so we would credit unearned ticket revenue $1,000. Our journal entry would show the date of the transaction. For our example, let's say they received the cash on September 1st. Then cash would be debited $1,000, while unearned ticket revenue would be credited $1,000. Later on, Company XYZ earns the ticket revenue after hosting the event. For our example, let's say that the tickets were for a baseball game. Now that the revenue has been earned, an adjusting entry must be made. Unearned ticket revenues recorded in liability accounts have been earned, so without this adjusting entry, liabilities would be overstated and revenues would be understated. For our adjusting entry, we would need to debit the liability account and credit the revenue account. If the game happened on September 29th, we would say that our journal entry says September 29th with unearned ticket revenue debited $1,000 and ticket revenue credited $1,000. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.